Non-current assets, long-term liabilities, provisions, contingencies, equity transactions, and directors' remuneration represent significant areas of financial reporting that often involve complex accounting treatments and substantial management judgment. Under ISA 500 Audit Evidence, ISA 540 Auditing Accounting Estimates, and relevant International Financial Reporting Standards, IFRS, auditors must obtain sufficient appropriate evidence to support the assertions of existence, rights and obligations, completeness, valuation, accuracy, presentation, and disclosure. Because these balances frequently involve large monetary values and long-term contractual arrangements, material misstatements may significantly affect the financial position and performance of the entity. Consequently, auditors employ a combination of inspection, recalculation, external confirmation, analytical procedures, inquiry, and examination of legal documentation to obtain reliable audit evidence. The principal audit objectives for tangible and intangible non-current assets are to verify that recorded assets genuinely exist, are owned or controlled by the entity, are completely recorded, are appropriately valued, and are correctly disclosed in accordance with the applicable financial reporting framework. Auditors obtain evidence by inspecting purchase invoices, supplier contracts, title deeds, registration documents, lease agreements, and board minutes authorizing capital expenditure. Physical inspection of significant tangible assets provides persuasive evidence supporting the existence assertion, while reconciliation of the fixed asset register to the general ledger confirms completeness and accuracy. For intangible assets such as patents, trademarks, licenses, and software, auditors review legal documentation, acquisition agreements, development records, and management assessments supporting recognition criteria. Particular attention is given to impairment indicators and useful life assessments where significant management judgment exists. Audit evidence relating to depreciation and amortization focuses primarily on the valuation assertion. Auditors evaluate whether depreciation methods and useful lives are consistent with accounting standards and management's expected pattern of economic benefit consumption. Recalculation of depreciation charges confirms mathematical accuracy, while inspection of asset registers verifies acquisition dates, cost allocations, residual values, and accumulated depreciation balances. Analytical procedures comparing depreciation expense with prior periods and average asset balances may identify unusual fluctuations requiring investigation. Auditors also assess whether indicators of impairment exist by reviewing operational performance, physical condition, technological obsolescence, and market conditions. Where impairment indicators arise, management's recoverable amount calculations should be critically evaluated and supported by appropriate evidence. The audit of profits or losses arising on disposal of non-current assets requires verification that disposals have been properly authorized, accurately recorded, and recognized in the appropriate accounting period. Auditors inspect sales agreements, disposal authorizations, board minutes, invoices, cash receipts, and legal transfer documentation to confirm occurrence and ownership transfer. The carrying amount removed from the accounting records is recalculated using fixed asset registers and accumulated depreciation schedules, while proceeds received are verified through bank statements and contractual documentation. The resulting profit or loss on disposal should be recalculated independently and presented appropriately within the financial statements. Cut-off testing ensures disposals occurring near year-end are recognized in the correct accounting period. The audit objectives for non-current liabilities include confirming completeness, existence, valuation, classification, and disclosure of long-term obligations. Audit evidence is obtained through inspection of loan agreements, bond documentation, lease contracts, board approvals, bank confirmations, and correspondence with lenders. Auditors verify principal balances outstanding, repayment schedules, interest rates, security arrangements, covenant compliance, and classification between current and non-current liabilities. Recalculation of accrued interest expense and review of post-year-end repayments provide additional evidence supporting recorded balances. External confirmations from financial institutions represent highly reliable evidence regarding borrowings and associated obligations. Analytical procedures comparing financing costs with average borrowings may also identify unusual relationships requiring further investigation. Provisions and contingent liabilities present particular audit challenges because they involve significant estimation, uncertainty, and management judgment. Under accounting standards, provisions should be recognized only where a present obligation exists arising from a past event, settlement is probable, and the amount can be estimated reliably. Auditors examine legal correspondence, warranty claims, environmental obligations, restructuring plans, taxation disputes, and contractual commitments to determine whether recognition criteria have been satisfied. Management calculations supporting provisions should be evaluated for reasonableness, consistency with historical experience, and alignment with external evidence where available. Subsequent events occurring after the reporting date often provide valuable evidence regarding estimate accuracy and should be considered carefully during audit completion procedures. Audit procedures relating to contingent liabilities focus primarily on disclosure rather than recognition because such obligations depend upon uncertain future events. Auditors obtain evidence through inquiry of management, inspection of legal correspondence, review of board minutes, examination of insurance claims, consultation with legal advisors, and consideration of regulatory investigations or litigation. Management representation letters may provide supplementary evidence but cannot substitute for more persuasive independent documentation. Where contingent liabilities are significant, auditors assess whether adequate disclosure has been provided within the financial statements to enable users to understand the nature and potential financial consequences of the uncertainty. The audit of share capital, reserves, and directors' remuneration concentrates on verifying authorization, occurrence, completeness, accuracy, and disclosure. Share capital transactions are examined through inspection of board minutes, shareholder resolutions, share issue documentation, prospectuses, share registers, companies' registry filings, and bank records confirming receipt of subscription proceeds. Reconciliation of issued share capital with statutory records confirms completeness and accuracy, while examination of constitutional documents verifies compliance with legal requirements governing share issues and capital maintenance. Reserve movements are traced to supporting documentation, including profit appropriations, revaluation reports, and dividend declarations, ensuring that transfers are properly authorized and accurately presented within equity. Audit evidence relating to directors' remuneration requires careful examination because of its sensitivity and governance implications. Auditors inspect employment contracts, service agreements, remuneration committee minutes, board approvals, payroll records, pension contributions, bonus calculations, share-based payment arrangements, and taxation records to verify that remuneration has been appropriately authorized, accurately calculated, and correctly disclosed. Analytical procedures comparing directors' remuneration with prior periods and company performance may identify unusual movements requiring explanation. Particular attention is given to related party disclosures and statutory disclosure requirements applicable to directors' compensation and benefits. By combining documentary inspection, recalculation, physical verification, external confirmations, analytical procedures, inquiry, and review of legal documentation, auditors obtain sufficient appropriate evidence regarding non-current assets, liabilities, provisions, contingencies, equity balances, and directors' remuneration. Comprehensive testing of these significant financial statement areas enhances the reliability of financial reporting, supports compliance with accounting standards, and enables auditors to express an informed and independent opinion on whether the financial statements present a true and fair view in all material respects.